World Bank praises Ghana as a frontier economy. Inside Mahama's early economic reset. Welcome to Dr. Dan's channel. This is where we slow things down, zoom out, and examine the forces quietly reshaping our world. Not through headlines or hype, but through structure, power, and long-term impact. Today, we're looking at why the World Bank is now describing Ghana as a frontier economy, and how President John Mahama's resetting agenda is shaping a new phase of stabilisation, from the Cedi's comeback to tighter macroeconomic management, while the IMF remains both a partner and a constraint. This is not a victory lap, and it is not a declaration of success. It is an early signal. And the difference between a signal and a headline is that a signal points to direction, not destination. 1. What the World Bank actually said and why it matters. The World Bank's International Debt Report highlights a major change across low-income economies, a shift toward domestic borrowing, largely to reduce exposure to foreign exchange risk. Across low-income countries, the World Bank notes domestic debt rose from about 8% of GDP in 2014 to around 17% of GDP by 2024, more than doubling. Ghana is singled out as one of the frontier cases, a country that didn't just borrow locally, but deepened the domestic market enough to issue longer-term local currency instruments. And the key detail here is maturity. The World Bank points out Ghana has been able to issue local currency bonds with maturities exceeding 15 years, which reduces the refinancing pressure that kills many developing economies. But the same report includes a caution. In 2025, domestic borrowing shifted more towards short-term instruments. The World Bank notes 41% of new domestic debt issued in that period was short maturity, increasing rollover and interest rate risk. So the message is balanced. Ghana's domestic market has matured, but the structure can still become risky if short-term issuance dominates. This is frontier status, progress with pressure. 2. Where Ghana was 2 years ago. Why this shift is not cosmetic. To understand why the World Bank's wording matters, we need to remember how close Ghana recently came to losing macroeconomic control. Just a couple of years ago, Ghana faced a severe crisis cycle. Currency volatility, inflation spikes, debt distress, and shrinking policy space. This pushed Ghana into a restructuring process and an IMF-supported stabilisation program designed to restore credibility and rebuild buffers. That backdrop matters because what we're seeing now, stable inflation, stronger currency performance, improved confidence, is what recovery looks like after a near breakdown. Not perfect, but materially different. 3. Currency stabilisation and the Cedi. The most visible improvement. One of the clearest signs of macro stabilisation has been the currency. According to the Bank of Ghana, the Cedi appreciated by roughly 40% against the dollar in 2025. That is not a minor move. That is a regime shift compared to prior years where depreciation was the norm. Some international observers even ranked it among the better performing African currencies during that period. So what drove that? Several reinforcing factors. Improved fiscal coordination, stronger inflation targeting, higher domestic interest rates earlier in the cycle, increased gold-linked inflows, reduced speculative pressure, and more disciplined foreign exchange management. And here's the operational piece many people miss. The Bank of Ghana has been using an FX intermediation program, not to peg the Cedi, but to reduce volatility during seasonal demand spikes. We have hard figures for this. In December 2025, the central bank sold about $721 million to the market under this program. For the following month, it signaled capacity to sell up to $1 billion depending on market conditions. That matters because the first quarter is historically difficult for the Cedi. Import restocking, dividend repatriation, and corporate settlement demand all spike. and the Bank of Ghana has tried to frame the interventions explicitly as liquidity smoothing, not a permanent exchange rate anchor. That distinction matters. A peg is a promise. Liquidity management is a tool. One collapses when reserves run out. The other buys time for reforms to work. 4. Gold, reserves, and the structural support layer. Gold has quietly become one of Ghana's most important macro stabilizers. Rising gold production, stronger management of inflows, and tighter oversight of gold-linked FX channels have strengthened Ghana's external position, and that supports reserve buffers. And here, we should be specific. The narrative circulating in Ghana's public debate, especially around gold-linked interventions, includes claims that gold initiatives generated over $10.8 billion in foreign exchange inflows, pushed reserves toward the $11 to $12 billion range, and helped Ghana meet reserve targets years ahead of schedule. Whether all these figures are ultimately validated line by line depends on audits and official reporting, but the macro logic is sound. If gold inflows are captured transparently and recycled into reserves, they can reduce panic FX demand and stabilize confidence. That has 3 downstream effects: reduced fear-driven dollar demand, stronger investor sentiment, and more room for cautious monetary easing. But here's the important analytical boundary. Commodity-backed stabilization can buy time. It cannot replace productivity reforms. Gold can stabilize today. Only structural transformation sustains tomorrow. 5. Inflation, interest rates, and the Deloitte warning. This is where the IMF element becomes unavoidable. A key reason Ghana's stabilization is being taken seriously is inflation dynamics. Inflation has been easing, and nominal rates have fallen sharply from crisis levels. A concrete example from Deloitte's West Africa macro assessment: the 364-day Treasury bill rate fell to about 13.06% by November 2025, down from roughly 30.07% a year earlier. That is a major reset in market pricing. But Deloitte also issued a warning, and it aligns closely with IMF logic. Yes, rate cuts can support credit and demand, but excessive easing can reverse inflation progress and weaken the currency. Deloitte's assessment notes that while the Cedi was projected to average around 13 cedis to the dollar in 2026, loosening monetary policy too quickly could undermine recent gains, especially if global conditions change and gold demand softens. So you have a consistent message from the technocrats. Stabilization is real, but if you cut too fast, you can unbuild the credibility you just rebuilt. 6. The IMF. Partner, constraint, and the politics of conditionality. Ghana's IMF program matters for one reason above all: credibility. The IMF signals discipline to investors. It constrains fiscal excess. It forces sequencing, but it also limits flexibility. The IMF tends to judge success through inflation control, primary balance, debt sustainability, and reserve adequacy. And Ghana's domestic debate often wants something else: jobs, wages, affordability, and visible expansion. That tension is not unique to Ghana. It exists in almost every IMF program country. So here's the reality check. The IMF's job is not to maximize growth. It's to minimize crisis risk, which means Ghana's challenge is to achieve growth within the credibility frame, not outside it. And that's why the World Bank's frontier economy phrasing matters. It implies Ghana is expanding its domestic policy toolkit, deepening local debt markets, lengthening maturities, improving resilience, so it can depend less on external lifelines over time. 7. The domestic economy, VAT reform, consumer reality, and the transition lag now. Stabilization on paper must translate into life, and the transcript you provided captures a very Ghanaian reality. Reforms do not automatically show up at the till. On VAT reforms, a tax consultant explained that while some businesses have removed abolished charges like the COVID levy from receipts, prices may not immediately fall, partly because firms are still selling stock purchased under the old tax structure. He suggested the visible consumer benefit could take a month or two to filter through. He also warned about compliance confusion. Some smaller firms believe threshold changes mean automatic VAT deregistration, but authorities clarified that deregistration is not automatic. What this tells us is simple. Policy reform is one thing, compliance ecosystems are another, and that's why enforcement and education matter. Otherwise, the relief may be captured by businesses instead of being shared with consumers. 8. So, what does Ghana need to sustain this? If Ghana wants to convert stabilization into durable growth, 4 priorities stand out. First, keep the domestic debt market deepening, but reduce over-reliance on short-term issuance that creates rollover traps. Second, maintain currency credibility by treating FX interventions as liquidity tools, not political promises. Third, keep monetary easing disciplined. Rate cuts must follow inflation realities, not public pressure. Fourth, shift from commodity-backed stability to productivity-backed growth. Investment, exports, industrial capacity, and employment intensity. This is where Mahama's resetting agenda becomes a genuine test. Not whether it can stabilize, but whether it can sustain the reforms once the crisis memory fades. Final reflection. Ghana is not fixed, but Ghana is moving. The World Bank's Frontier label signals that Ghana's domestic financial architecture has improved. The Cedi's approximately 40% appreciation in 2025, combined with reserve management and measured FX intervention, including $721 million sold in December 2025 and a planned $1 billion window, shows active stabilization tools are working. Deloitte's data, including the fall in the 364-day T-bill rate from about 30% to around 13%, reinforces that macro conditions are materially better than recent years. But both the World Bank and Deloitte imply the same conclusion the IMF would. Progress is real, but fragile and reversible. Ghana's next phase is not about headlines, it's about whether stabilization becomes structure. If you found this analysis useful, subscribe to Dr. Dan's channel for clear, in-depth breakdowns of the forces shaping our world. Like the video if it helped your thinking, and share it with someone who values depth over noise.